Welcome back to GoldSeek TV. I'm Vanessa Collette here with Michael Kosowan. He's an investment executive with Sprott. Welcome, Michael. It's great to have you back again.
Thanks, Vanessa. It's great seeing you again. It's been a while.
Yeah. Now, Michael, you're a little bit of a different type of broker. I mean, you have a technical background. You're an engineer. So you do a little bit of analysis in addition to, investing and recommending stocks. So what's your take right now on the recent gold price decline that we saw? It took a lot of people by surprise.
Well, I think for your viewers, to try to make it simple, a very complex problem, but with a bit of a simple points to it, I think you can boil it down to two words. One is hegemony. The second is Shanghai. Hegemony, what I mean here is really the US dollar has been in this dominant position for so long. It's gone on a lot longer than most people have thought. It's been proven to be the distressed currency or the world reserve currency that people have been going to because it represents such a deep store of value. And I think that its dominant position, it's clearly a very crowded trade from my perspective. The second point, Shanghai. The Shanghai slump or the Shanghai surprise that happened with the Chinese markets coming off the way they did, I think has had a fall-on effect to commodities in general. There's a lot of introspection about how much gold the Chinese have been importing. And a lot of the numbers out of Hong Kong alone over recent years indicates that that number is probably to the order of about 3,000 tons.
Right.
Meanwhile, the official report from the PBOC has been only about 1,600 tons. But I think a lot of that additional gold, or that differential, if you will, was probably being used as collateral. Because remember, a couple of years ago, the Chinese housing market in particular was overheating. So what they wanted to do was cool it down. And as such, I believe they started borrowing US treasuries, using that money, and in turn going out and buying commodities, and buying Chinese equities and Chinese yield instruments. And now that the Shanghai surprise has occurred, it's meant that they've been dealt a margin call. And a margin call that they've had to deal with something. So this is similar to what we saw in 2008, 2009, where the market starts coming off, the dutiful margin clerks want to get coverage on that short position, so they sell the collateral. And the collateral has been the commodities, which is why a big part of the reason you're seeing it widely span across the space.
Right.
So it's not just gold. A lot of people at this conference are going to be very curious about gold primarily, but it's certainly affected copper, iron ore, and the list goes on and on.
It's interesting that you see this interrelation between the gold price decline and the recent Chinese stock market declines. So we haven't really looked at that as of yet, because a lot of people might interpret the stock market decline there as being representative of overall problems in the economy, not so much being collateral needing to be,
I think going back to the Chinese economy, they attempted to slow it down as we just discussed. And then it wasn't until about a year ago that they started to include some stimulus measures to get things going. But that was 12 months ago. And remember, these big economic policies take time. It's sort of like trying to get in shape to run a marathon. You can't just do the runs for a few days and then expect to be able to be that well trained. It takes a while to build up and develop to that kind of level until they can get the economy going again. And I think that's why you'll probably start to see a turn probably in Q1 of next year, possibly sooner.
Right, so you're talking about higher growth numbers.
Higher growth numbers out of China. I don't think I don't think that we can put it in the casket just yet. I think that it's certainly something that's still going to be a strong driver.
Right.
And to add to that, the hegemony that the dollar has enjoyed is probably going to be under threat a little bit by the euro as well, as they implement growth policies there also, or stimulus policies more accurately, that are starting to get that economy on a bit of a roll also. Worldwide, the central bankers are really running an experiment, and it's a pretty dangerous one. As an analogy, it's kind of like having Frankenstein's monster laying out there on a big platter, and we've got the electric bolts all fired up and ready to go, and they're sitting in the sky, and we've got the storm going on. So all we're waiting for is that thunderbolt to hit. And I think that the market's volatility and fear in the market has to do with what's that monster going to be like when he gets up? Is he going to be benign and help the villagers with their crops, or go out and destroy their livestock and make things even worse?
Right, yeah, they're playing God, and I mean, one thing we know for sure with markets is intervention never seems to be a good thing.
No, I can't remember the last government policy to mind that was a great thing.
Right. So you see the Chinese, I mean, we know that they have a lot of tools yet that they haven't deployed. I mean, North America, Europe has been devaluing, and we've been in this currency war with competitive devaluations, but China hasn't done that. So they still have a lot of different things that they could do to stimulate the economy. You think we're going to see more of that?
I think that's a great point. I think the Western economies have been in a race to the bottom, and whoever wins is obviously going to be a Pyrrhic victory, whatever winning means. But I think the Chinese currency has certainly stayed solid. They stayed to their word of pegging it at about 6.2. And that's where it stayed. So I do think that they have additional stimulus measures on all different accounts. And it is a command and control type of a marketplace. So I think that when they do enact those policies, they may be more swift than we're able to do in the West.
Right, yeah, they tend to enact things quite quickly there. Now, where do you see gold going now? I mean, with what's happened recently?
Well, I'm really excited by some of the headlines I read in the general media these days. In fact, I saw gold's headed to 350.
Yes, I saw that one.
Gold is no better than a pet rock or some such thing. So the media is certainly out there, and that's affecting sentiment a lot. You typically need to see that in the process of things. I mean, you may recall the last time we spoke, we talked about the 4M checklist that I had for you in identifying a good opportunity to start buying stocks. And one of those M's, as you jokingly said, was misery. Tell me all about misery. Well, I think this qualifies as the misery component that was essential and missing. The question on people's minds is this the third round of capitulation? Do we need that third round at all? Is this kind of an exhaustive event? I think those questions are really best answered in hindsight, but I think for right now, looking at sentiment as an indicator, it certainly is at these
as negative as it can get, absolutely.
Probably in 3 decades.
Right.
Yeah, absolutely.
Yeah, and the capitulation, I mean, you're saying that this is the third round in this market so far that we've seen.
Well, I'm not calling this the third round, but I think that that's what a lot of gold watchers are certainly seeking.
There's 500 to 600 companies or so that apparently are kind of zombie companies that need to be cleared out.
Yeah, that's a great point too, Vanessa. I think that what we've seen in the gold price and the senior gold companies is they have been very responsive to this market turn down. They've been rational, in other words. The area that probably has stood to be irrational is the junior space, which represents both its own opportunities and its own risks. The risks are there because obviously some of these 600 companies need to go. They need to blink out of existence, they need to merge, they need to delist, they need to find a new business model, something else. But the opportunities are that the good, the bad, and the ugly have all been drawn down in this cascade effect that we've seen in the gold space. So I think that the rare gems that are in there are going to represent really good opportunities to pick up because they're trading on the cheap. They're trading at valuation levels that we haven't seen in a decade and a half easily. And some of these really great projects are very rare. And remember, we haven't done a lot of exploration. A lot of exploration dollars have not been expended over the last 2 decades. So they're even more rare, if you will, and some of them are in the hands of the most iconic and the most experienced management teams that we have out there. So I'm pretty excited about that prospect and being able to buy them cheaply for my clients.
Great. Well, thank you so much for joining us today, Michael. It's a pleasure.
My pleasure as always. Thanks, Vanessa.